I won't win if founders really are caring more about valuation than their partner. I much more am geared now with the team to do pre-seed heavily. Roll up our sleeves, come in, and because we're an industry-focused investor, you'll find that we have opinions on parsing your customer discovery. How do you think about your product and the order you build your features? How do you think about go-to-market? And that usually then comes into, we love to make customer introductions. Behind Dynamo is a robust network of mid-size and Fortune 500 decision makers across supply chain, technology. I can call them when I'm evaluating a company if I want a little more data in my mosaic of information. But equally, I'll say, hey, so-and-so needs to do some customer discovery. Could they come to you for perspective? Or better yet, could they show up and pitch your team? Because we heard that you're looking for XYZ solution. We have that in the portfolio. And then the last thing is, how do you set them up for success, which is how do you build a team, right? We'll go through this exercise. What does your organization look like today? What does it need to look like tomorrow? Where are the gaps? How do you start filling these gaps? How do you coach a first-time founder to empower these people and manage them to success? We have resources that we avail to them that allow them to do that better, such as a CEO coach or a CTO coach, or frankly, we've found in more recent years, just putting together peer learning groups. They oftentimes can learn more from one another than from a talking head.
Santosh, welcome to the Slice Pod, where we uncover the stories of fresh emerging managers across the early stage venture landscape. You are the co-founder and managing partner of Dynamo Ventures, an early stage fund cutting checks into seed stage supply chain and mobility startups, two very hot topics right now. Let's begin where we always do, and before we get deep into the vertical and the strategy and everything else, how did we get here? Was this always the plan to have your own fund? How did you find yourself in this chair?
I've been a VC now for nearly 10 years. It'll be 10 years later this year when my co-founders and I decided to go establish Dynamo and, begin that journey. But it wasn't always the case that I wanted to be a VC. I didn't know what VC was till I was probably a couple years out of college, like truly understand and appreciate what venture capital is. But I'll take you back because I strongly believe that the environment in which somebody grows up has an immense influence on who they are, how they think, the types of things they're interested in. So I was born in India. When I was about 2 years old, my parents decided they wanted to immigrate here to the US, just have a better life. There's a lot of kind of funny things going on in the corporate environment in India at the time. And both my parents grew up in India. You have what I call railroad brat, right? Yes, you have military brats, but both my mom and dad were a part of railroad families. So every few years, their dads would get repositioned to a different city. I remember expressing this to one of my co-founders, Ted, about 10, 11 years ago. And he's like, dude, this is in your veins. And I told him I love trains. I geek out on it. When I had my first kid, first thing I did was buy him a Thomas the Train set and just sit there and for hours we would just play with it. And my wife would kind of walk by, think it's ridiculous, but that's why, right? And so when we moved, or when my parents rather moved us to the US, I ended up spending my formative years growing up about an hour outside of DC in Columbia, Maryland. Very mid-Atlantic upbringing. You're in the middle of this kind of melting pot of cultures, perspectives, as well as industry. And when I say industry, it's not just commercial and private sector, but being that close to Washington, D.C., there's a lot of government. These days, it's in vogue to also talk about defense, but like Fort Meade is just something that I remember I used to drive by every day, right? It's not kind of this thing where you're going on a pilgrimage to get something done. And so as I was growing up, when I was about 6 years old, my dad taught me how to program a computer. I wrote my first computer program. And these days, now that I have my own kids, I recognize it was likely because I was a real pain and he needed something to occupy me. He occupied me by saying, why don't you build me an application that helps me with my weekly expenses? It was in the old DOS system. You had the black backdrop, the green type. And from there, I was, oh my gosh, computers can do so much. And I got hooked. I remember I used to harangue my dad at work. He had this library of programming books, and I asked him for these obscure, like, could you bring me the Perl book next and C++? And I was like, oh, I don't, C++, there's no internet aspect to it. I discovered the internet. I go, I want things I can host and my friends can visit online in a browser. So I really kind of got into how do you set up your own website? What does that mean? There was no cloud back then. You had very few cloud hosts. You had, I think, like Tripod, GeoCities. I equally was learning DevOps on nights and weekends that my dad would teach me. When I was 13, I started to, like any teenagers, my friend has some nice stuff. Like, I want nice stuff too. And you go to mom and dad, and my dad's like, I understand where you're coming from. This is never happening. Remind me, we've been in the country for about 10 years. It's not like we have a ton of savings. Life's comfortable, but there's never any excess. He pointed out to me, you go get a job. So I tried to go get a job, but who's going to hire a 13-year-old? I came back and he goes, well, I've taught you some skills, and these skills are in need. And maybe you could find somebody and convince them to pay you money in exchange for your skills. And that's how I started my first business. It started off more like a agency, and then I bolted on a bunch of tech support, all for SMBs in my hometown. This at the time, and probably even now, relatively underpenetrated with this type of professional service, late to come onto the technology train, so they just feel left behind. So I'd show up at your door and I'd say, hey, technology is clearly going to change the way your business works. I'm happy to work with you to purchase all of your workstations, set them up. You probably need on-prem servers if you want an online presence. And the business grew through high school. I was hiring my friends, training them, managing them. And as I was approaching the age of 18, getting ready to go off to college, that's when kind of naturally I saw the market subside because you had clouds starting to emerge. So it was a rather kind of natural and organic decision as to what do you do with the business? You just kind of shutter it. I went off to Penn State to study finance and information systems, maybe at the surprise of my parents, who thought I was going to pursue a degree in computer science. I remember it was super contentious when I told them, I go, yeah, I'm not doing that. I'm going to go do this thing called finance that, if you think about the Indian culture at the time, not as prestigious as medicine or computer science or a hardcore engineering discipline. But I articulated to them, hey, ultimately, the world is stitched together through the way dollars flow. And I believe that a technology education is still very important because technology is going to change the world. I wasn't quite as well spoken and articulate as Mark Andreessen when he said software eats the world. That's kind of what I was getting at. They supported me. They said, go on. You're responsible now for yourself and your education. And so was a proud Nittany Lion, got a great education, some amazing real world experiences, and also partied a little bit along the way. But between my second and third year of college, I started my second business with my college roommates. And what we were angling at was the distrust we were starting to see as the Great Recession was unfolding between households who were seeking an understanding and perspective on the financial markets, investments, economic commentary, and those who were providing it to them. And the reason we did this was we wanted to get jobs on Wall Street. We've been brainwashed to some degree by the finance department and, you know, the dean and the broader organization that was at the school. And so we said, oh man, we could stand apart by starting our own business relevant to this sector. And how are they going to say otherwise that we're not rock stars, right? And so we did that for a few years. We ended up getting syndicated by Jim Cramer in the Street. There are a lot of people that are pleading with us to get rid of that notion of going to Wall Street. You have something interesting here. Figure out how to blow it out. But we were short-sighted in retrospect. Everybody got a job on Wall Street. And we ended up selling that business to a group of private Canadian investors for about 4x whatever we all put in. So that was a decent outcome. It wasn't life-changing, but I was the guy buying drinks at the bar my senior year when others were trying to scrounge together some change. I got to New York, and like most of us who go to New York out of school, spent some time in a banking program, and I had convinced myself that I wanted to start my own hedge fund. Somebody pointed out many years ago when I expressed this, they're like, it's funny that you defaulted to you're going to start your own hedge fund rather than join your own hedge fund. And I pointed them, I go, it took me about 10 years to realize that my default state is to start something rather than joining something. As a result of
Unemployable.
that, I'm completely unemployable at this point. And the reason I always default to starting something is I view it as, well, you can kind of control it. The success or the loss is largely in your hands, right? So you have no one but you to blame if you're not working hard enough or smart enough or surrounding yourself with the right type of people to accomplish whatever you're looking to accomplish. But that hedge fund notion was seeded in part during my time in college, where one of the amazing experiences I did have was to steward a portfolio of about $1 million worth of technology stocks. That $1 million was a part of a $3 million fund that the school had raised in a very traditional way from a lot of wealthy alumni that were believed that like such a real world experience was critical to the long-term success of the student population coming out of Penn State. So like I had to argue with LPs, explain to them why I'm not liquidating my portfolio as the stock market was trending down in 08, 09, right? Like a lot of experiences as a 19, 20, 21-year-old, like you wouldn't get anywhere else. But when I kind of pursued that I want to start a hedge fund, I ended up shifting to an equity research role. And guys, I'll tell you, I, about 6 weeks in, almost went back to my old boss on my knees asking for my old job back in banking. I hated it. I did not give a damn about tracking the iPhone gross margin to the fifth decimal point. Something like Apple, super exciting to cover, was in my coverage universe, but I just didn't fundamentally believe that's what moves the market. And that's where I was starting to get exposed to VC, because part of me joining that particular group was to start building out relationships in the late stage private sector growth stage companies. And equally, you start to run into their funders and their backers. And that's what reignited and got me into a values exercise. What do you value, Santosh? Why are you here? You're making more money than an average 20-some-year-old would in the US, but you're just so deeply dissatisfied and unhappy with where you are in life. And that's where I realized I'm actually a builder. And I have this finance thing I really like. I like to build as well. I don't think a spreadsheet does justice to the complexity of building and running a business. How do I get into VC? My starting point actually was to figure out, do I just go start another startup? Because the conventional wisdom, this is circa 2013, 14, 15, was, oh, you're a nobody if you come off of Wall Street, right? You don't have any stature, position, or belonging in Silicon Valley startups, which sucked. But there are a few people that I clung on to who kind of gave me hope. And it was like people like Fred Wilson, Bill Gurley, right? Who actually came from a more non-traditional background, more aligned to kind of what my background was at that time. And that's where a buddy of mine kind of saw me chasing my tail. He goes, I have a dude you need to talk to. Lives in Chattanooga. He's relatively young, just sold his freight business. And he just loves mentoring people who are high energy, high ambition. And so that ended up being one of my co-founders, Ted. Ted kind of pointed out that part of what you are at risk of losing as you age, Santosh, is your willingness to take risk, right? As you get married, as you have kids, as you start to get comfortable. And he's like, don't let yourself get comfortable, because like I can see you're ready to go. But when your heart and your mind are ready to leave New York or that role you have in New York, let's come chat again, spend time together. And that ultimately, over the course of about a year or so, ended up in us sitting in a room and effectively coming to the decision that, hey, we should start Dynamo. There's a gap that my other co-founder, whose name is John Bradford, had identified, that for industrial and supply chain businesses back in 2015, 16, the pre-seed seed stage. And his question was, why does this exist? Because I'm coming from a world of 15 years investing in fintech, and I have seen ecosystems around fintech emerge in London, New York, Hong Kong, San Francisco. And it's because you stand on the shoulders of giants, the way those industries are structured. And he made a very astute point. The world of how we make, move, and monetize the world's goods and freight isn't materially different. So he's like, one, there's a gap. And he's like, two, if we're in the Southeast at that point having this conversation in an office about 10 minutes from where I'm calling you today, there's no better place maybe than to kind of have a leg in as a fund than here in the Southeast. We have a high density of manufacturing, transportation, and frankly, even also a deep understanding of how does trade credit work, right? How do payments around freight exist? A lot of the intermediaries are also in this part of the world. And so we set out, we raised our first fund July 2016. It was a baby $18 million fund. And we were just trying to have a chance of proving out that this is a sector that was deserving of venture attention. And to some degree, the rest is history. That fund ended up seeding Stored out of Atlanta, that is a unicorn that we're first check-in, Sender out of Berlin, who is the preeminent digital freight brokerage, the only U.S. investor in that company for a long time, certainly the only one when we led the seed. And Gatic AI, who is turning into one of the leaders in autonomy based in the West Coast. So credit to those founders for allowing us to continue to persist and raise additional funds. It's been a hell of a journey. And these days, what we think about and look at is top of mind with the trade war we're currently in the middle of waging with the rest of the world.
Massively. And we'll get to that in a second because I really want to talk about it. I'd imagine that in 2016, in Chattanooga, Tennessee, there wasn't necessarily a culture of venture capital. How did you raise that first fund?
Oh, I've been laughed out of many rooms, many. And that only kind of hardens the chip on one shoulder, right? Hey, you're doing venture? You're doing it where? And you're doing it in what sector? The door's right there because we don't want to be trolled today. We have better things to do. And it's like, we're not being a troll. We genuinely think that this is an opportunity that's been overlooked. Two of my partners, Ted and Barry, who I founded the firm with, had jointly sold their freight business along with their third co-founder. That created generational wealth and really changed the city. As a part of the exit of that business, there are a lot of people who now are sitting in a high net worth stature and have operating experience, and they wanted to reinvest more locally in entrepreneurship. They were doing that independently, like an angel investment effort, not as regimented and rigorous. But when we all came together, Ted, Barry, and my partner, John, said to me, we do this if you want to do it, Santosh. You have the passion, you have the motor, you have the desire, and maybe the vision to help us figure out where we're going. Our job is to help you out and empower you. At which point, Ted and Barry said, we'll help you raise that fund. We have a lot of social capital that we built up because of our business success in the region, but you need to figure out what it means to source companies. How do we pick the right ones? And what does it mean to care for them? These, I talk about it as sourcing, selection, and stewardship. That is the core of our firm. I wake up every morning thinking about these three things when I talk to the rest of my team. Right. And so when we practically went out to go raise as a fund one, because there are a lot of folks that are sitting in that position today or are contemplating, hey, I want to do this at some point. How do I do it? It's making sure first and foremost you have a team, right? I would not be able to do this by myself. Because I had a team and was willing to understand and lean into that and thinking in a more long-term way. Sitting in those meetings, understanding what sophisticated LPs, but equally unsophisticated LPs are asking. How do you qualify that you want to take someone's money versus someone else's? Part of dealing with an unsophisticated LP or someone who doesn't understand venture as much as they might end up bothering you all the time. And that's the worst thing that could happen to a GP. And so that's something that I really impress upon first-time managers. Sometimes it's okay to say no to somebody if you don't think they understand your strategy and it's not a good fit, because you risk actually souring what is otherwise a good relationship. Why do that? But we have a large foundation here that really anchored us, very active in venture, runs a large illiquid allocation, and 2 family offices behind them. And the thing that I would also say, because I don't know whether it's discussed enough, is that a lot of the flyover states is where there's a lot of generational wealth that's been built and compounded over decades, if not centuries. Chattanooga is famous for a lot of the Coca-Cola wealth accrued into the Chattanooga ecosystem, right? A lot of that comes from the Coca-Cola bottling empires that have been established, consolidated, spun out, all kinds of corporate activity. But you see that being a very important part of the LP base or the potential LP base that can then give an emerging manager their start. And even when we go out to raise fund 2 and fund 3, we always kind of look at some of these key geos and say, where is their wealth that has been built in industry? Because naturally, these people understand what we're doing because they've lived it firsthand, or they remember dad or granddad talking about, hey, it was such a pain to plan, shift, and schedule labor at the facility. Or I remember having to drive that load to the destination because the truck driver gave up on me halfway. And so when you have these people in your first fund, they understand what you're talking about in terms of the problem you're solving, but they're also either an entrepreneur themselves or close enough to an entrepreneur where you start to pull on their heartstrings a bit. It's like, I'm giving the next generation a shot. And I think that emotional bit is very important to build in. And I can say that in hindsight, I was completely ignorant of it in the moment. But from there, we drew concentric circles around our city and ended up drifting a bit into the Midwest to finish that first fund, a bit further south and a further north. And that's how we got to about $18 million. And that kind of core 3 anchor in fund 1 has persisted as we now are investing out of our 3rd fund. So very grateful for them putting us in business.
That's amazing. And sounds like they understood this space that you wanted to play in. You were able to prove there is money to be made at the earliest stages within that specific vertical. What sort of valuations did you used to get in around that 2016 mark relative to today? And is the fund size, kind of like the increasing fund size, a function of market inflation of seed prices? Do you feel like you're playing the exact same strategy and just the check size is getting bigger because the valuations are getting much higher? Or is it a different portfolio construction that you have evolved over time relative to that first MVP type of fund?
Yeah. So in that $18 million fund, our post monies or caps were anywhere from about 5 million. And I think the richest thing we did, if I remember correctly, was 12 to 15 million. How insane is that? Right? $18 million fund. The thing that we shifted, and it's because we knew we wanted to be in this position, is our fund size has not only gone up, but also because we knew we wanted to show up and be the lead writer. And by the end of fund 1, we were leading deals more often than not. In fund 2, probably 75% of deals we did, we led or co-led. In fund 3 now, everything we're doing, we're leading. And so the way we thought about our fund progression, it went from roughly a $20 million fund, a $40 million fund, and roughly a $55 million fund 3. And the thing that we philosophically aligned on when we were setting off to raise that second fund is just because there's more money on the table doesn't mean we take it and raise it. No one here is going to benefit from more fees. It's a short-sighted way to build a firm. We need to be what we oftentimes call long-term greedy. Greed might be faux pas to talk about being an investor, but you want a level of greed with your founders and LPs, and you should have a level of that yourself. That's part of what helps you raise capital, invest it, and then harvest it back at multiples higher. It's because we wanted to lead that the fund sizes went up. There's probably a little bit of inflation, but we are extremely regimented about is we want to come in early, and that's how we get strong ownership. So 5% target became about 10 to 12% targets in fund 2. And in fund 3, that's now 12 to 15%. We made the conscious decision, we're not going to squabble at seed, where in fund 1, it was about 50-50 pre-seed seed. Fund 2, roughly that. Fund 3, there's a lot of nonsensical valuations at the seed stage. And part of that is the belief that enduring household tier 1 funds raised a lot of capital. About 2023, when the COVID punch bowl was removed, you start to see the market reset. So their Series A focus was starting to come under question. What is a good Series A? They didn't really know. It took them probably a year or more to really answer that. But you can't draw a management fee and not make investments. So we start to see them do a bit more seed investing. Some of them will own that it's an option check. Others will say it's now a core part of our strategy. But that froth has persisted. And I'm not going to try to fight that with a $55 million fund. I won't win if founders really are caring more about valuation than their partner. So I'm happy to do that more by exception. I much more am geared now with the team to do pre-seed heavily. Roll up our sleeves, come in, and because we're an industry-focused investor, you'll find that we have opinions on parsing your customer discovery. How do you think about your product and the order you build your features? How do you think about go-to-market? And that usually then comes into, we love to make customer introductions. Behind Dynamo is a robust network of mid-size and Fortune 500 decision makers across supply chain, technology. I can call them when I'm evaluating a company if I want a little more data in my mosaic of information. But equally, I would say, hey, so-and-so needs to do some customer discovery. Could they come to you for perspective? Or better yet, could they show up and pitch your team? Because we heard that you're looking for XYZ solution. We have that in the portfolio. And then the last thing is, how do you set them up for success, which is how do you build a team, right? We'll go through this exercise. What does your organization look like today? What does it need to look like tomorrow? Where are the gaps? How do you start filling these gaps? How do you coach a first-time founder to empower these people and manage them to success? We have resources that we avail to them that allow them to do that better, such as a CEO coach or a CTO coach, or frankly, we've found in more recent years, just putting together peer learning groups. They oftentimes can learn more from one another than from a talking head.
I'm assuming that the creep in ownership is a reflection of the value add and how much time you spend with these people now that you have a fully fledged Collie platform.
I like to think so. I believe that you earn your right to be a fund that can lead rounds. To your point, I do think it's because we showed up in those early days and we were not trying to be everything to everybody. We could do three things well: show up informed and opinionated on product and sales, introduce you to customers, and help you hire with talent. And we just continue to pull those threads and just deepen and lean into that even more. And while we don't have like a traditional platform like you see a lot of mega funds have, we have enough resources around us that we can introduce and allow founders to tap into in order to grow themselves, in order to scale their businesses and their companies.
What did you find, these founders? Is there like a square mile radius in Chattanooga? Is there a little cafe where they congregate on the weekend?
I wish. Maybe what we haven't addressed so far is we invest globally since our first fund. 2/3 of our fund has been invested in North America and the balance overseas. There's a concentration in Europe, but LATAM is clearly becoming very important to us. And we have a smattering of companies elsewhere in the world as well. In order to set up this sourcing apparatus, the day after we said we're going to go do the fund, I remember harvesting from every source I could find a list of all of the relevant startups in our sector. I proceeded to do cold outbound. And I would sit in a glass conference room. Lunch would generally be brought in right into where I'm sitting. I would start at 7 in the morning and stop at 7 in the evening. People thought I was a madman. They're like, that dude never leaves the office. And I remember my partner Ted had tells me he is a madman, but that's why he wants to win that bad. What was underpinning that was there was no one who had a lightning rod for these startups to come to and congregate and aggregate around, right? That's one issue. But two, what right do I have, being a VC in Chattanooga of all places, telling you should take my money? I know what we're doing, and we could help you go build a big business. We don't necessarily have a track record. So it was earned with outbound sourcing, and we still do that today. Take destiny into your own hand. Be aggressive about it. The thing that we realized that it wasn't the intent, but it's as natural learning is when you do outbound, it raises awareness of what you do. And I think a lot of people are simply indexed to, well, how many investments did you get out of that? Well, you get a couple from every fund. But what you cannot quantify is the fact that awareness is going up, and that's why we get referrals. And so the next major pillar is referrals. At the start of Fund 2, my partner John and I sat down and we're kind of dismantling our entire sourcing apparatus. Almost think of it as somebody dismantling an engine to clean it, improve it, figure out what's working, what's not. And some data suggested that every time we got on the phone with a VC, up to 10 days after, we would get trailing deal flow. Before a meeting, you'd find 3 or 4 companies that you think would be interesting to this VC. So when you're receiving something and you have nothing to give back, that makes you feel a little uncomfortable and weird, right? Like you feel like you have to reciprocate. And VC is all about trading cards. These cards are interesting deals and founders you're talking to. And so we said, how can we make that intentional? Because we now need to bring in associates into the firm and teach them how to do this stuff. The last bit is inbound. And I'd say it's still a work in progress, but being around for about 10 years now, we have a newsletter that is read by founders, corporate decision makers, other investors. And we put it out every week like clockwork. We have our own podcast where we talk about a lot of the subject matter relevant to our industry. And so people start to realize, oh, like that's the rally point for this industry. We haven't had one. It's dynamo.
How do you know where the puck is skating though? Like whether you go outbound or whether things are coming inbound? And maybe that's where we get into the hot topic du jour. There's 2 big mega, I don't know if they're tailwinds or they're for sure opportunities. One, it's what's happening at the global level, trade tensions and how those will get resolved. And it's autonomy when it comes to logistics, not just the Waymos, but also what happens inside a warehouse, what happens to that good being moved around. It's probably not going to be a human that is going to do this in a little bit of time. How do you as a team look at all this deal flow and know where to spend your time relative to the view of the war you've constructed around the thesis in the context of, I just mentioned 2, but I'm sure that there is more, kind of like these massive shifts that are happening at a global level?
The benefit we have in being a specialist is that we can spend a lot of time thinking deeply about certain opportunities or white space in our sector. We increasingly describe what we do less as supply chain and mobility. The vastness and the foundational nature of what we're investing in is fully captured there. And instead, we're starting to change our language to talk about funding the relentless founders that are challenging how the industrial economy works. When we say industrial economy, we're talking about reimagining how we make, move, and monetize freight. We can pick a particular subject matter, and somebody's always working on a thesis internally. There's never work not being done. The thing that we need to have first and foremost the patience and fortitude for is the recognition that even if we're an industry investor, we first and foremost invest in people. And there's a saying, if you're in our meetings, we remind each other, 80% of any decision we make comes down to the team. And I've seen that proved through time and time again. You give a really strong team a average market opportunity, they come back to you with a great market opportunity. But you give a team maybe that isn't as well constructed an amazing market opportunity, may not guarantee success. And that's our philosophy. Everybody has their own. There's beauty of ventures, different ways to generate return. But this is one that's worked well for us. The second part, core to our values, is the concept of you have a strong opinion, but it's loosely held. And actually how we talk about it is strong opinions, curious minds. So it's okay to have a thesis, have a perspective. But when there's data and anecdote that might counter the wisdom that you hold conventional at your firm, you need to have a process and the intellectual honesty to retest and recrank through that work you have done. And that's the beauty of meeting founders in an environment and a market that's changing very quickly, right? This isn't something where we say we dictate, we know what's right, what's wrong. We have some opinions on how these things need to be built and constructed and formed, but ultimately the founder knows better than us. If we feel that we know more than a founder, we're not making the investment. I can tell you that almost assuredly. Somebody that doesn't have insight, right? We oftentimes look for insight at the early stage that we're investing at, because if I can find and buy into your insight behind why you're doing what you're doing and the way you're doing, I can then help you craft that into something that's defensible. When you compound that over time, it turns into a moat. It drives me nuts when some investors ask a pre-seed company what their moat is, or seed company, or arguably a Series A company. They're in the middle of building it. Also, we don't invest just based on the theses that we're developing. We're open to, hey, you're pitching me something. We might be knowledgeable in it, but there might not be a piece of paper you pull off and deliver back to the founder. Because we spend time equally talking to corporate decision makers, we're like, oh yeah, like RFQ tooling. Yeah, we were just off the phone with a manufacturer and they're telling us their annual spend is X and they're trying to get it to Y. This could be interesting, but have you thought about this integration, or how do you embed in the workflow? How do you think about pricing? Because they're getting more sensitive around fixed cost. You end up having a much different level of conversation, and the founder can lead you potentially to what is interesting. It's not just on us. And that's the beauty with working with amazing founders. Oftentimes they lead you to opportunity you couldn't even imagine. And that's where outlier returns exist.
I want to get more personal and talk about what were the hardships over the last 8-10 years of switching into the role of an emerging manager. You had a lot of luck and you made a lot of that luck, literally positioning yourself at the right place with the right kind of partners. But I'm sure it wasn't all easy.
Not at all. The number one thing that I grapple with for probably the first 7 years and occasionally still is imposter syndrome. Why am I here? Why do I deserve to be here? Am I even qualified? Why should somebody take my check? Why shouldn't they take that person's check over there? It took a long time for me to realize I was feeling a version of imposter syndrome, and finding a community of similar emerging managers that could express something similar, we would sit with it and realize it is something normal. We're challenging norms. We're coming in. We're trying to create this new thing to our vision. At times align with the conventional way that venture works. Other times going against the grain and challenging how venture works. For example, sharing our investment memo with every CEO after we invest. Other VCs get uncomfortable, and I just want that level of transparency, right? So like that's one, and it comes and goes. When it comes, it might be, hey, like maybe such and such thing at the firm or portfolio company level that I thought would happen didn't happen. So have I lost? Do I actually not know what I'm doing again? And again, I encourage every emerging manager, you find a peer group because you'll be able to learn and support one another. My partner, John, and I also ran into a guy who's been super generous with his time, but has also been a very great sounding board from an LP perspective, named Eric Sipple. And Eric has been impactful to numerous fund managers, not just us. But Eric is the guy where I could email Eric right now, guys, and say, Eric, I need to speak to you tomorrow morning. Eric will give me time. And I could share to him in complete transparency what we're grappling with. And he's just a great sounding board. Hey, I've seen other firms walk through it this way. Other firms, when they fail in this regard, this is why I believe. When the ones that succeed, this is why I believe it. But he'll leave it to us to figure out what the ultimate decision, right, is to undertake. So that's one thing. Fundraising, everybody's going to say, right? But let me dig in a bit deeper, because fundraising is hard. Fundraising is much harder when you're talking about a vertical industry that has not taken as much venture capital historically. And therefore, there's not a track record of companies somebody can point to and say, oh, yeah, like these $5 billion plus exits were all venture backed, right? Getting through that, part of it is demonstrating to prospective LPs the vastness and the significance of the market, right? Industrial economy, we think about how things are made, moved, and monetized. That sounds more vast than supply chain and mobility. We had to relinquish our ego, and it took us many years, sadly, to do that because we wanted to be so accurate and right. It's part of being an industry investor, like our credibility is being accurate in industry-oriented language. But we found, hopefully, what I think works to get both founder, LP, and corporate together, understanding what we're all about. But in addition to describing the vastness and convincing them of the opportunity, they're also, in a strange way, like we're buying the team, they're buying the team. In our most recent fundraise, we actually had an LP that ultimately committed, ended up being one of our largest LPs. But she actually, like on our third or fourth meeting, said, hey, before we get going, you guys are just so transparent. And I just want to ask, is there a gotcha somewhere? And she equally said, you don't chase me either. She's like, all these other managers, when they find me, they chase me. They don't leave me alone. We say, listen, you're buying the team. And we're trying to prove to you that we are transparent people, we're good stewards of your capital, and we're great partners to founders. And part of that is we're not going to breathe down your neck because we're professionals and realize you need time to conduct your work. And if we feel like you're not responsive, we'll come after you. But that hasn't been the case. And so also demonstrating that, hey, like we can run an institutional grade firm. And we have the ambition, by the way, to make it generational. It would be terrible, as I sit in front of you, April 2025, if the firm stopped to exist or ceased to exist because the original founding partners were no longer active. And so part of it is also how we think about how do you bring the next generation of the firm up and into the ranks. Probably the third thing, which is more near term, and I wrote about this in early January as the new year set in. And I wrote, I think, something like, this is probably one of the hardest years I've ever had as a VC, 2024, because a lot of things came home to roost. Let me lay it out for you. One, you had companies that were seeded during the COVID heyday, then shored up a bit with some type of extension, generally by insiders, because the market was recalibrating and they needed more runway to achieve Series A metrics. Then we had AI show up and pull the rug out from all of us. And so what is the company who was not born in an AI native era? How are they built differently or similarly to an AI native business? And dealing with that dislocation, last year, you had to have a lot of hard conversations with founders that are emotional, but it was the right thing to do for the company. Even if the founder in the short term were like, oh, those Dynamo guys, they're not telling me what I want to hear. Well, you don't take our money because we're going to tell you what's right for your company you're building. The conclusion of that is there's kind of several write-downs one had to take. And be party and kind of winding down businesses, whether it's selling them, liquidating them, helping teams land on their feet. That's hyper emotional. That's tough because as a pre-seed investor, you have a connection to your founders that no other investor will have. You put them in business. You believed in their dream. You believed in them. And now things didn't work out. It'll be okay. You have to be professional about it. When things go bad is when we build our reputation. When things go good is when you build return. But if you don't behave appropriately and are not supportive and humanistic when the downside strikes, you won't have a reputation to even experience the upside in this industry. And I tell people the bad things we do or negative experiences are etched in our memory a lot longer than the positive experiences we have. So we always need to be mindful about that.
But entrepreneurs don't fail, they learn. There is always a cost of tuition. No lesson is free. How have you built out the firm over the last 3 funds? Starting out, you and a couple of senior partners. Today, you have a fully fledged team. How did the day-to-day systems evolve over time? And do you feel like you're at a place right now where this current configuration is what's going to carry you to that kind of like generational handover? Or is there more work that needs to be done? Like usually people say after the third fund, it's when you really see a team coming together. It's when you should have all your ducks in a row.
We're all equal partners. We made decisions together. To this day, everybody needs to say yes to an opportunity for it to be invested in. I think that's important. That equality, everybody having a voice when you're a partner, that doesn't create any weird struggles over power. There's also no deal by deal at Dynamo. Everybody participates. There's no his deal versus her deal versus my deal. And because everybody needs to say yes, as we are very sensitive to the risk of groupthink. So it's very frequent you will find myself and my partner, John, playing devil's advocate. It might be the deal that I was excited by. It came through my network. I've done a bunch of the work, but you'll equally see me flip to the other side and say, but yeah, I know this team's great, but what about this? What about that? Is the market really robust? What I tell people is you're trying to take the deal if you could have physically hold it and look all around it to make the best decision. And with that is a culture that we hope we engender as we have more mid-career investors now in the firm. We could debate. It's not about an individual being right. It's about us collectively finding truth. And how do we do that together and nobody feel threatened or embarrassed? It's because when we find truth, we all stand to gain if the company works out, right? And every member, I was very, very opinionated about this. Doesn't matter what you do, you get some portion of carry. My EAs over the years have had carry. Associates have carry. I think culturally, the benefit is stronger than the admin burden that one needs to bear. That is alignment. In Fund 1, you're really talking about one active partner undertaking a lot of the investment and operational rigor. Something like Streak was simple enough to use on the back of Gmail and Google Docs. Very simple. Life started to get a little more complicated as there are more choices going into Fund 2, where we replatformed to Affinity, Notion got stood up, and we start to adopt a mindset where if you do something more than 2 times a year, it has to be very rigorously documented. And there's like a template formulation that I put together. It needs a peer review. And there's usually a quarterly or biannual check-in of that process. And when you do a check-in, you question, has something changed with how we need to get it done? Is there a smarter way to get this done? Why are we even doing this to begin with? Should we even be doing this? I get made fun of as like, hey, like you're the process guy now. And I go, oh, I hate that word. But I do it because what is our product that we sell as VCs? It's our decision-making process is the product that I sell to LPs. And how can I ensure that it's consistently high quality, but make avenues for where we can test it and experiment with it around the edges in an effort to improve it? But also, as an emerging manager, I need to scale myself. And the way I can do that delegation and handoff without worrying is the work product at the level of the quality the founder of the firm wants it to be, is you document it. And by the way, if you can automate it, we're also automating it. So it used to be more Zapier. Now you can imagine it's more around the world of LLMs and GPTs. One of the big goals for this year, how do we re-platform our operations for the next decade on a more AI native and agentic base? How can we get more leverage for ourselves? Because if we had had a chat 5 years ago, I would have told you probably 3 partners in the firm. Every partner would have an associate. Over the last 6 to 9 months, we're at a point where we go, what is the role of an analyst and associate at a firm in an investment making capacity? Aren't all the agentic tools we have, if it's stitched together in the right way, bringing you a very similar, if not the same, ability? And by the way, it scales a lot better as well. It's a lot more affordable. So you can kind of tell we're constantly experimenting. Like one cannot rest on our laurels. I have a 6x net fund. That fund yeah, that might have helped me kind of perpetuate stay in business, but I'm always going to be judged by my next investment and the quality of the firm operations.
How do people get in touch with you? What's the best way? Do you have a medium of choice?
Thank you for asking this question. Do not message me on LinkedIn. Odds are I'm not going to respond. Santosh at dynamo.vc. I will respond to you. We respond to every cold inbound the firm gets. Please don't LinkedIn me. Don't find my phone number. Don't text me. Don't WhatsApp me. Certainly don't try to call me. But get me on email, and I guarantee you I'll get back to you.
I agree. Not everybody does, but I definitely agree. And it's something I should get better at. But you're good on your emails. Let's stay there. What did we miss? What is the one thing that you're going to walk away from this conversation and be like, damn it, I prepared a whole week to spill this pearl of wisdom. Fabri didn't ask me, and now nobody's going to get to hear it.
VCs don't do the hardest work in this ecosystem. The founders do. I will never detract from the founders. All credit to them for the successes you might see on my TVPI or my DPI. But venture amongst VCs and LPs, this is a really hard period to be in this industry. You're seeing a distribution drought that is ongoing. I'm hearing more talks again of a denominator effect issue. You have funds that overraised in historic cycles, deployed too fast in prior cycles. So there's a segment of zombie funds that have emerged. What's success? Like, it's very hard to say because some of those zombie funds might be sitting on good companies. They just didn't give those companies enough time to prove themselves out before going back to market. A lot of my peers and colleagues will phone me and say, dude, like, you kind of enjoy fundraising and we don't understand you, but let's do a bit of therapy. And I did not enjoy fundraising, Fabri, till a few years ago. I think I had lunch with Michael Kim and asked Michael, I go, do you like fundraising? And he looked at me and goes, I do. And I asked him why. He goes, it's that period every few years where you can share your enthusiasm, your vision, your excitement for this thing that is your baby and convince others to equally appreciate it nearly at the same level and amount. That was a total mindset shift for me. I embraced fundraising just like that. Now I think about it as like I evangelize the sector and the opportunity by doing that. I help my peers, like my buddies at Iron Spring in that process, Schematic, Fontanella, Concert, like people who like industrial subject matter in that process. But the reason I kind of bring this up and I say this is something that we haven't touched is it's very easy to get really upset that, hey, I didn't get to my target or fundraising is going really slow. This is arguably the worst environment to be fundraising in. So my advice would be maybe it's less about the target and think about what is the minimum viable size for you to authentically execute on your strategy. You have to be ready to make sacrifices.
This was great. What I don't say very often is I want to take the first flights to Chattanooga and spend some time in person with you. I think we spend quite a bit of time with the focus of Slice is like fund 0 to 1, kind of like that's where we are. I think you still have that builder energy, that entrepreneurial spirit, but you're a couple of funds down the line and you can really tell that you have internalized a lot of the lessons that some of the early managers struggle and grapple with. And it's a beauty to see. Honestly, it's quite magnetic. I think that originally when we first started looking at you on paper, I did not appreciate you particularly, but you guys as a team bring to the table. When you say it's a $50 million logistics seed fund and you're like, wow, that must be so exciting. And then obviously certain things that are happening that shine the light on the actual space. And then you start thinking about who is well positioned to actually execute there. And it's like, well, somebody that has been there before, somebody that has done this when it wasn't sexy, when it wasn't topical, right? And then you want that team to actually care about what they do. One of the things that shines from your interview is how much you care. Starting to get to Fund 3, you get to know what it is that you're doing, but that shine, that luster starts to fade away. And that's not the case here. This is wonderful. You have the energy of a Fund 0 manager, but the eloquence of a Fund 4 manager. It's great.
Appreciate it.
It's really rare to see.